Welcome to the Quick Bite series by the Insurance Domain Training Center. In this video, we will explain out-of-sequence transactions. Those working on P&C insurance projects may be familiar with the complexity of this transaction. For those who haven't encountered this transaction before, a basic understanding of policy service transactions is necessary to grasp the concept of out-of-sequence events. As this is a complex transaction, we have included examples and scenarios in this video to aid in your understanding. Let's begin by understanding in-sequence transactions before delving into what constitutes an out-of-sequence transaction. In this example, a policy was issued with an effective date of January 25, 2023. If you're familiar with insurance policies, you know that the effective date is the coverage start date. Each transaction within a policy also has its own effective date, which is crucial in determining whether a transaction is out of sequence. Pay close attention to these effective dates in comparison with the completion date of each transaction to grasp the concept. Now, revisiting our example, the first transaction for a policy change was completed on February 23, 2023, with an effective date of February 25, 2023. The second transaction for a policy change was completed on March 13, 2023, with an effective date of March 15, 2023. Here, you can observe that the effective dates of the transactions are in sequence, which is the typical scenario. However, there are instances where this is not the case. This is referred to as an out-of-sequence scenario. Consider a policy issued on January 25, 2023, followed by a policy change completed on March 13, 2023, effective from March 15, 2023. Subsequently, another transaction is triggered on March 17, 2023, with an effective date of February 25, 2023. Even though the triggering and completion dates are in sequence, the effective dates are not. The later transaction triggered on March 17, 2023, ideally should be the first transaction based on the effective date. Consequently, the initially first transaction becomes the second transaction, resulting in an out-of-sequence transaction. In an out-of-sequence scenario, a specific transaction is triggered after the completion of the first transaction, but its effective date precedes that of the first transaction. Let us go deep into a business scenario to understand. A personal auto policy was issued on January 13, 2023 to July 13, 2023. When issuing the policy, there is only one vehicle added to it. The deductible is $250. On April 4, 2023, a policy change was initiated to increase the deductible to $1,000. The effective date of the transaction was April 4, 2023. On April 7, 2023, another policy change was initiated to add in another vehicle and also to make the deductible to $500 for both the vehicles. I repeat here, the deductible was reduced for both the vehicles. However, the effective date of this transaction is April 2, 2023. The first transaction effective date is April 4, 2023, and the second transaction effective date is April 2, 2023. So these transactions become out of sequence. Pay close attention to the next few slides as we delve into the explanation of conflicts and non-conflicts arising from out-of-sequence transactions. As you've learned from the previous slides, the processing of a later transaction in certain scenarios leads to an out-of-sequence situation. However, it's possible that the same field changed in the first transaction is affected in the later transaction, creating a conflict. We'll illustrate this with examples in the next slide. If the same field is not impacted, it's considered a non-conflict transaction. Therefore, out-of-sequence transactions can be classified into two types: conflict transactions and non-conflict transactions. Let's explore a scenario in the next slide. The scenario presented here illustrates conflicts. Let's revisit the example we discussed earlier. In this case, a policy was issued on January 13, 2023, for a 6-month period with one vehicle. A policy change with an effective date of April 4, 2023, aimed at increasing the deductible for the vehicle was processed. Another transaction on April 7, 2023, with an effective date of April 2, 2023, was processed to add another vehicle and change the deductibles for all vehicles to $500. Since the effective dates are not in sequence, this becomes an out-of-sequence scenario. However, there's another issue here. Both the first and second transactions attempt to change the deductible for the first vehicle with conflicting effective dates. The first transaction has an effective date of April 4, 2023, while the second transaction is prior to that on April 2, 2023. This situation is termed a conflict. Remember this scenario clearly, as we will address how to handle it later in this video. These scenarios will not be reiterated while explaining. In this slide, we will examine a non-conflict transaction. Let's revisit the same example we discussed earlier with one change. In the later transaction, a vehicle was added, but there is no change in the deductible. Since each vehicle generally has a separate row in the database for a specific policy, it does not impact the same field in the database. Therefore, there is no conflict, and the system processes this out-of-sequence transaction with no conflicts. Let's explore how the system handles conflict scenarios. In instances of conflict, the user will be alerted about the conflict, and it will be prompted in the system as a conflict. The user can then decide which option to keep. In this particular scenario, the user can choose to retain the deductible of $500 from April 2, 2023, for the first vehicle or opt for $1,000 from April 4, 2023. Depending on the user's choice, the system will process the out-of-sequence transaction accordingly. Based on the user's choice, let's understand how the system reacts. If the user decides to keep the deductible of $1,000 from the first transaction, the system drops the conflicting portion of the later transaction. Since the first transaction is already processed, only dropping the conflicting portion ensures the user's choice is maintained. In this scenario, the addition of the second vehicle will be considered out of sequence. For example, if the user opts to keep the second transaction's $500 deductible effective from April 2, 2023, then the field has to be updated for the conflict. This might involve reversing the first transaction of $1,000, updating the deductible to $500. The premium would need to be recalculated, and billing installments adjusted accordingly. This is the typical process for handling out-of-sequence conflict transactions in systems, although it may vary from one system to another. In some systems, the later transaction is taken as a default and processed. Up to this point, we've focused on policy changes in out-of-sequence scenarios. However, there are other transactions that can also be out of sequence. Let's explore those. In certain scenarios, a cancellation, a reinstatement, or a rewrite can be considered out of sequence. You should already be familiar with these transactions from our previous lectures. If you need to refresh your memory, please revisit those lectures to recap and gain a better understanding before proceeding to the next slides. We are illustrating an example of what constitutes an out-of-sequence cancellation. We've chosen a scenario similar to what we discussed earlier. A personal auto policy was initially issued, providing coverage from January 13, 2023, to July 13, 2023, for a duration of 6 months, with a deductible of $1,000 for a vehicle. A policy change was then processed on April 25, 2023, reducing the deductible from $1,000 to $500. However, a cancellation was triggered effective April 23, 2023. If you examine the effective date of the first transaction, it's April 25, 2023, whereas the later transaction is dated April 23, 2023. This discrepancy classifies the transaction as an out-of-sequence cancellation. On the effective date of the cancellation, there was no policy change, and accordingly, the cancellation has to be processed. Any refund has to be adjusted based on that date. This cancellation nullifies the earlier policy change. In this slide, we'll delve into the concept of out-of-sequence reinstatement. By now, from our earlier lectures, you should have a good understanding of what reinstatement entails, restoring a cancelled policy to an active state. Reinstatement is the only transaction that can be performed on a cancelled policy. Similarly, if there's an out-of-sequence cancellation, it can be restored using an out-of-sequence reinstatement. Let's illustrate this with a scenario. We'll use the same example we discussed for out-of-sequence cancellation earlier. An out-of-sequence cancellation was executed on a policy on April 28, 2023. The very next day, April 29, 2023, a reinstatement was triggered. Since it involves an out-of-sequence cancellation, this transaction is necessarily categorized as an out-of-sequence reinstatement. Now, the question arises, what happens internally in the system during an out-of-sequence transaction? Let's explore that. To grasp the dynamics of out-of-sequence reinstatement, it's beneficial to comprehend what occurs during out-of-sequence cancellation, as the two are interconnected. In an out-of-sequence cancellation, a previously processed policy change is reversed. Subsequently, during out-of-sequence reinstatement, the cancellation is reinstated, and the reversed policy change is reapplied. The objective is to reinstate the policy to its state before the cancellation. This process triggers premium recalculations and billing. Any reversal records created must be reapplied once again. This brings us to another out-of-sequence transaction, out-of-sequence rewrite. When key field changes are required, and they cannot be executed through a policy change, a rewrite transaction is performed. For instance, a change in state, which impacts coverages, limits, etc., cannot be carried out through a policy change. A rewrite completely rewrites a policy as if it were new, while retaining the history of the earlier policy. Let's examine how a rewrite becomes an out-of-sequence rewrite. A policy change was processed, effective January 25, 2023, which decreased the deductible from $1,000 to $500. Subsequently, a rewrite transaction was initiated from the inception, from January 13, 2023, to change the issuing state of the policy. As a result, the first transaction has to be reversed during the rewrite process and reapplied based on the changes once again. This is referred to as an out-of-sequence rewrite. So, now you understand what constitutes out-of-sequence transactions and the different types involved. It's time to explore how these out-of-sequence processes impact the overall transaction process and what considerations need to be taken into account when developing a software system. When a user initiates a process, the first step is to determine whether the transaction is out of sequence. Each transaction must be validated against business rules to ascertain whether it falls into the category of out of sequence. If it does not, the standard process takes over. If it is determined to be out of sequence, the next validation checks for conflicts. Recall what you've learned about conflict aspects in out-of-sequence transactions. If there is no conflict, the transaction is processed as out of sequence directly. If a conflict is identified, the user is prompted with an alert to resolve it. The out-of-sequence transaction is then processed based on the user's selection. It's worth noting that in some systems, the process may differ, with the latest transaction being taken as the default and processed as out of sequence. Therefore, this process can vary from system to system.
Thank you for watching the Quick Bite series. Please don't forget to subscribe to the channel and provide a thumbs up if you like this video. Visit our website www.insuu.com for formal courses and certification.